Title of today's roundtable is U.S. regulators are trying to kill crypto. But the original title before we change it was U.S. regulators are fucking crypto. And frankly, they are. We've seen a ton of companies moving offshore. Galaxy announcing today that they were doing so. The biggest market makers that we had in the space are gone, which means illiquid books, no volume, and $5 Bitcoin orders sending price up $75,000 directly to $1 million. Guys, it is a shit show in the United States. Is it over? Will we survive? I'm discussing with today's amazing panel. I've got Sid Powell, Scott Dykstra, and Joshua Frank from the tie. Let's go.
Let's go.
What is up, everybody? I'm Scott Melker, also known as the Wolf of Wall Streets. Before we get started, please subscribe to the channel and hang your head in shame on the like button if you are, in fact, unfortunate enough to be an American like me. I mean, I just told you all the bad things that are happening in the United States, and I failed to even mention that the IRS is jumping ahead of FTX's unsecured creditors for like $80 billion. What? I mean, the insanity in this country. Imagine you were really psyched. Hey, it's going great. I'm an FTX creditor. I'm going to get like 70% of my money back. And then the IRS comes and steps ahead and said, not you, us first. I would be surprised if I wasn't a Voyager creditor myself and had not been bent over this desk so many times that I can't even recall by bad news in the bankruptcy process. Proving that, once again, not only is the United States trying to kill crypto, but they also just hate their citizens. They just hate us. They hate us. Bankruptcy, scam, scam, scam. So now that I've laid that table for all my guests who now are probably ashamed to have joined us, I have Sid Powell, Scott Dykstra, and Joshua Frank. So I got a good giggle out of you. We got two Scotts in hats. That's a first on the show, guys. You're witnessing history here. Scott, it's your first time here. Welcome.
Glad to be here, man. Appreciate you having me.
Absolutely. So how bad is this over here?
I mean, I don't know. It's about to go viral, but we're about to see it's so bad that Congressman Brad Sherman is just trying to blame crypto bros for all the U.S.'s failures this morning. You're about to see that all over the news.
I mean... So this is what he said. I don't have the quote in front of me. We should bring up the video, to be honest, but I wouldn't want your guys' eyes to burn out of your heads like the guy at the end of Raiders of the Lost Ark. We wouldn't want that. But he basically said crypto bros have printed money to make trillions. And they said, and the U.S. government also prints money, but it's cool, guys. We're the U.S. government.
We do it all the time, but we don't like it when crypto bros do it. That's for sure.
Yeah, I mean, okay, but that's worth talking about, though, because let's be honest. I know nobody here really wants to talk about meme coins, but he's missing the point with the United States government part. But crypto bros literally are printing money right now and making trillions, right?
Absolutely.
Yeah,
Well,
I've made like 3 trillion, so I don't know.
3 trillion. You've made 3 trillion, but thank you for showing up still. Sid, you were going to say something. Go ahead.
Yeah, well, I think it's interesting that we saw Tether's latest report where they showed, they were more profitable this past quarter than BlackRock was. So if that doesn't show that this is a profitable business that people are willing to pay for, then I don't know what does. At least that, hopefully, provides some incentive for financial institutions to start banking and servicing the sector.
Yeah, I mean, the numbers on Tether, I'm scrolling down, were absolutely absurd. I know I tweeted it yesterday, but they basically, I don't have the exact number, but 1.7-ish billion they made in the quarter and now have over 2.5 billion above their reserves.
Above the reserve, yeah.
So Tether has kind of slowly dispelled all that FUD, right? And my favorite thing is when I tweeted about
their
that.
balance sheet isn't US dollar equivalents, though.
I'm sorry. Probably in Chinese commercial paper.
There was a lot of gold and other things on the balance sheet that wasn't US dollars, and I don't know personally. If I was putting my money in a stable coin, I still would like to see it. Like, just put it in treasuries. Like, you can get enough yield from treasuries. Like, why are you playing games. You don't need to be playing games. You're making
Are they
so
really
much
in
money.
gold? I thought that they were in treasuries and cash at this
No,
point.
they had $3 billion of it was
Mostly,
in gold.
yeah.
But $3 billion is a lot.
There's gold, there's some secured loans, but I mean, I would suspect that these secured loans are, loans that are over collateralized with Bitcoin or something like that.
Interesting. So Josh, you're basically hinting, wink, wink, you'd still feel more comfortable with USDC.
Look, it doesn't say, I'm not saying I'm uncomfortable with Tether. That's not the point I'm making. I'm just saying is you think they have so much AUM. They're going to be printing so much money. Why not just keep it in cash equivalents?
Especially, I mean, I sat down with Powell 2 weeks ago, 3 weeks ago, and he was like, yeah, we're just killing it because treasuries are yielding so high. I mean, treasuries are performing better than whatever gold they're holding.
Scott, I'll share it. Here you go. Hold up.
Oh, I'm going to pull up a screen.
One of the interesting things to think about is that
we're venturing into new territory. What do you got there? I can't read that.
Can you see it now? Oh, wait, that's the wrong.
I kind of see it.
Up. There we go. I got the right tab.
Oh, there we go.
Yeah.
So you can see, 3.4 billion in precious metals, 5 billion in secured loans, 2 billion in other investments, $1.5 billion in Bitcoin. So 69 billion, of course, because it's crypto, is in US dollar equivalents, and the rest is not. I don't know why it would be so difficult just to put all of it in US dollar equivalents.
Yeah, that makes sense. But you'd need a hell of a bank run for this to be problematic at this point, at the very least, which I think is good. So we obviously talked a bit about the general situation, but let's get into some of these more specific things and how meaningful they are. It was Jump Crypto, and who was the other market maker that exited?
Jane Street.
Right, Jane Street and Jump.
Shop in the US.
I mean, weren't they the ones basically making this market on the large exchanges?
I got one thing to show you really quick on that, Scott, and then I'll
let me know when it's ready so I don't put up
it's ready.
War and Peace again before we get to the other thing.
Look at the hottest smart contract on Ethereum right now. Right now, this is over the last hour. So they pulled out of the US. Keep that in mind. They didn't pull out of crypto. So I think that's really important to note. They're currently the hottest in terms of the amount of activity that they're doing on chain over the last hour versus an average of the last 7 days. One of the Jump wallets, the hottest smart contract right now. So they are still interacting in crypto on chain as we speak. It's just out of the US. But keep in mind, they were out of the US for a while. They were already moving offshore. This isn't breaking news, as in it happened a day ago. Bloomberg might have gotten the story a day ago, but a lot of these guys were already offshoring.
That makes perfect sense. So then what does it exactly mean to say moving out of the United States? Is that simply like a new office address? Does it mean not making markets on Coinbase and Gemini? I mean, what does that really mean?
I think it's, I don't know on the making markets on US exchanges or not. I'm not sure, but I do know that they're going to be basically operating out of the other legal entities that they own, right? Everyone has a Cayman entity. A lot of these guys, like Galaxy had a Hong Kong desk already, right? Like Jump has a big Singaporean presence, right? So a lot of these guys have presences. Like Cumberland, which is DRW, primarily operates a lot of their crypto stuff out of London and has for years. So, this isn't necessarily new for a lot of these guys. A lot of them are just forcing people to work offshore or move offshore, which means no taxes to the US, which is, fantastic for us as U.S. citizens or residents,
well, we need more taxes. But I mean, it feels like a lot of this is sort of just political theater, right? I mean, Coinbase is not pulling their operations in the United States anymore, even if they open an exchange in Bermuda or if Brian moves his address. And these companies, as you said, are still operating here. Galaxy now moving quote unquote offshore. But so is this then, I guess, just all of them saying, see, told you so to regulators, will move, like calling their bluff to some degree? And then if so, does that mean that this isn't really that meaningful?
I mean, everyone has to consider it right now. It's an absolute witch hunt. So I agree it's political theater, but I also see it actually moving. Like operations, you're right. Coinbase isn't going to move 4,000 employees out of the U.S.
Right.
Engineering is in the U.S. Marketing, U.S. But like the feeling right now is that U.S. regulators are coming after the company, not just the Pepe meme coin makers. They're going after just like normal businesses that were already approved by the SEC 7 fucking years ago. And it makes me want to move to Aruba too.
Yeah, I wish I could do that. I wish I could do
Get
that.
my island on, my palm tree on.
I think if you have, you've got the market makers and the trading firms kind of moving offshore. I mean, this just kind of brings it into line with a lot of projects. Like you might have some core contributors to DeFi teams and NFT and gaming teams based onshore, but now, all the foundations are out of Cayman. The token issuers are out of BVI or Bermuda or some other jurisdiction that has sort of done the work to set up a framework for teams to operate safely.
I think the thing that scares me is that this is the prop trading firms that are now doing this, right? The prop trading firms, because they're prop, and for anybody who doesn't know what that means, that's listening, it means they're proprietary. It means it's their own money. They're not taking money from external LPs, right, or external investors. These guys, because they're proprietary, they don't deal with external money. They don't have the like if they lose money, it's their own money. They don't care. It's not external capital. There's not that reputational risk. The fact that these guys are shitting their pants a little bit is bad, really bad, because that means that for funds that have outside capital, right, all these hedge funds, all these asset managers, these large institutions that we spoke about moving into crypto, if the prop trading firms, which are the most flexible that have been in crypto for years, are now getting scared, right? Imagine how the traditional funds feel, right? And so it is a bad thing. Don't get me wrong. I think the prop trading firms that were profitable, that were making money in crypto, that went heavy into crypto, will continue to do crypto. They'll just do it with outside, through other legal entities. But I think your U.S. based hedge funds, think about a $50 billion fund, any $50 billion fund, right? They're currently managing $50 billion. They're taking $1 billion a year in management fees on 2%, right? It's not worth any sort of risk for them to get into crypto right now with $100, $200, $300 million. It's just a giant reputational risk. They're putting themselves in the crosshairs of regulators. It's just not worth it, right? So I think like all these prop trading firms will continue to do business. A lot of them already had offshore entities. They'll do a business offshore. My bigger concern is this just makes institutional adoption, it just pushes it out basically, at minimum until the next election cycle.
So you're saying the Harvard endowment doesn't want to throw all of their money into Pepe right now?
Well, the Harvard endowment is prop, actually. It's their own money. So that might be a little bit different. But some of those allocators are still actually allocating into crypto. They're still investing in funds, but it's certainly slowing. But a lot of those guys that have committed, what I'm suggesting more of is your Blackstones of the world aren't coming in and launching crypto funds next week, right? I mean, that's not, and I'm not saying them individually, but there's not going to be a huge push in that area to move into crypto, which is something that we started to move towards. If you remember, with Paul Tudor Jones coming into crypto in 2020, that kind of spurred this last bull market, right? Obviously Saylor came in and spent every penny he had and everyone else's pennies buying Bitcoin, which helped. But like that's really what kind of started this, right? And then you saw there are a lot of institutions that have come in that have adopted it. We thought that number would increase more, but this is really just sucking the air out of that from happening.
Yeah.
But to that point, Josh, like don't most of those, the $50 billion funds also have like a lot of offshore structures? Like it's pretty trivial for them to replicate what we're seeing with, Galaxy and Jane Street and Jump. But I do take your point that I think there's a lot of contingent liability because even though they were trading their own balance sheets, you can see there's probably a lot of, I don't know, there's probably like class action lawsuits looming on the horizon for, some of the activity by those guys in Luna, for example. And I imagine that by offshoring, they can kind of hive off that risk, keep it in a separate subsidiary or a structure where they can kind of insulate themselves from that.
Yeah. Look, I certainly these guys have offshore entities, and a lot of them are trading crypto with offshore entities already. So my point isn't that there are top 50, top 20 hedge funds that are trading crypto today actively, and some of them are even trading 50 tokens. There's a small number, but some of them are. But the number of new entrants is just flat. It's
are they trading Pepe?
I don't know if any. There are actually a few that we probably mutually know that probably are trading Pepe.
Yeah.
You go to the volume and to the liquidity, right? I mean, as sad as it is, if that's where it became a billion market cap coin. Plus, I'm sure that quite a few of them made profit, just like I'm sure quite a few people we all know made quite a bit and made us feel pretty bad about our lives and our choices. Not me, you guys probably, right? So listen, but so let's talk about a bit more positivity. What would be actually a good scenario out of all of what's happening with this regulatory nonsense in the United States, right? I mean, we've seen that the Lummis-Gillibrand bill is likely to be reproposed in the coming months. They've said it's going to be leaner and meaner. I mean, would some sensible stablecoin regulation get us partway there? I do feel like a lot of this is still just rhetoric, and that it's still not in the interest of the United States to just kill it. I mean, I was pretty shocked when I saw the Joe Biden tweet like 2 days ago that said, literally like comparing what the Republicans want to do to crypto bros violating tax loopholes, like as if every wealthy person in the world is not utilizing the same tax loopholes in the United States. The rhetoric is crazy right now, but Biden's going to die like next week anyways. So I mean, I'm just saying, what's the good scenario here?
If there's any silver lining, it's that like what we're seeing at Space and Time is a number of like financial institutions, major US banks that are coming in and they're building their own chains, they're building private ledgers, they're building like a US Web3, which is totally different, a complete bifurcation of the public Web3 we're used to, of the Pepe on ETH. Like this is something completely different that we haven't seen before. These networks that are forming on private ledgers that we've been hearing about behind the scenes for like 4 or 5 years, but it's finally all coming together. So US is basically just building their own Web3. They're just building their own private ledgers for all the banks to finally bring it. And then that's going to come to retail eventually, right? When these crazy like Greenfield, hey, I'm a major bank, I'm going to build a blockchain, comes to retail in like 2 years, we're just going to have a US Web3 that's just completely different than the Web3 of the rest of the world running on Ethereum.
Scott, is that the Canton chain you're talking about? That Demel-based one?
Canton is just one of them, right? Canton runs on Azure's confidential compute framework, right? Confidential compute framework. It's sharing assets between banks. But there's also banks building public-facing retail chains as well that'll probably come to light in 2 years or 3 years whenever these crazy greenfield projects form. What I'm saying, Scott, is like we're going to get a new blockchain, a US blockchain or some shit that's completely outside of like Pepe on ETH.
So I mean that kind of leads us to the like in it for the tech, right? Because that doesn't help anyone's coins or investments or a lot of the things they believe in. And this goes back to, I mean, after FTX collapsed, I sent some angry tweet that said, watch, Wall Street's going to come in and buy up our entire industry for pennies on the dollar. Like, watch. So that's not necessarily what's coming. But what you're saying is effectively that they'll build their own rails. They'll keep it closed off. It'll be using the technology, but against the entire ethos of all the things we believe in. And they'll just use it.
No, I'm saying they're going to keep it closed off today. In 2 years, that's going to come to retail. They're going to build all these public chains that are like the US's attempt to build our own. I'm not even talking about CBDC, right? Everyone's going to say, oh, Scott, you're talking about a CBDC. I'm not even talking about that. I'm talking about a single financial institution who has retail clients all over the US selling like their own chain as like their private ledger, which is effectively like Coinbase's Base, except Base went public right away. Like taking transactions.
That sounds like the information highway, superhighway theory back in the 90s, though, Scott, where it was like cable, like we're not going to have an open internet. We'll just have cable companies provide everyone with internet through their television sets. And I don't know. It's just like it strikes me as it's a really hard engineering problem. I just don't think the financial institutions can do it. I don't think I think they'll net be losers of customers who kind of debank themselves or go to, self-custody solutions.
Let me ask you something. Let's throw out a random bank. Let's say Wells Fargo. I have no affiliation. If Wells Fargo had their own chain, which would be absolutely insane, it'd be kind of batshit. Sid, would that make you feel more comfortable or less comfortable about Wells Fargo?
I have no strong feelings about Wells Fargo either way. I think I just don't think it'll get the distribution or the scale. Like, I think they will struggle with the engineering problem of it. We have, as a proof point, in Australia, the stock exchange went through its own private blockchain project and then ended up just writing off the entire thing. So I think Wells Fargo's would get written off well before it ever actually reaches retail consumption.
You don't think these firms will wisen up and bring in like a Space and Time or a Maple to help them?
Correct. I don't think so. Like, you're talking about the innovator's dilemma at a firm that is not set up to incubate new technology. Like, it's like saying that, General Motors was gonna, successfully throw a bunch of balance sheet at producing its own electric car and take out Tesla. Like, there is marketing, board decision making. The average age of Wells Fargo board is probably above 65 at this stage. How are they, like, they don't even believe blockchain's a thing, let alone producing their own.
I think it's also important to note that it's not the blockchain itself; it's also what's built on top of it, right? We have to talk about, well, what are the use cases? Anybody could fork Ethereum and have their own blockchain tomorrow, right? So is there anything actually built on it? Is anybody using it, right? I think, and I know Scott and I agree on this. Like, Scott, what is the number one killer use case of crypto right now?
Stable coins.
Pepe.
Right, stable coins. No, it's stable coins, right? And
stable coins built on Pepe, built on ETH, but yes,
that's a global thing, right? That's the fact that anybody anywhere in the world has access to a US dollar equivalent, right? In places that have incredibly high inflation, right? And can transact and can transfer that money incredibly inexpensively and incredibly fast, right? That actually solves a real world use case. Having a private blockchain operated by a major bank doesn't solve for that. I'm sure they can be like, let's charge 7% foreign transaction fee because you're sending to a non-US wallet. And by the way, let's send that transaction to every single regulatory body anywhere in the world, right? Let's broadcast that transaction. I don't think that's what, folks that are actually using crypto today. And there are some, there's not a lot. I'm not saying there's a lot, but that's not what those people are using it for. They're using it to, if you live in Venezuela, if you live in any country that suffers from high inflation, or if you're a foreign domestic worker in a different country, right? And you have to go to Western Union and spend 3 or 4%, which is the material amount of money to send money home.
10%.
Blockchain like that doesn't solve that problem.
These won't be speculators chains. These will be Venmo wire transfer chains. Like, I'm going to Venmo Josh in Venezuela through this chain, which I don't know if that doesn't sound fun, but that might be helpful.
I hate to say this, but what really solves that? Stablecoins might be the killer use case, but stablecoins on Tron.
Yeah, $40 billion worth of stablecoins deployed on Tron right now.
Shocked.
I know. I mean, I think it's like the most underreported, hidden under the carpet stat that we have in crypto is that the majority of stablecoins are sent fast and cheap on Tron.
Yeah, Justin's just out in the islands, just like the mayor of Suriname Island, just chilling, raking it in.
I think he actually got that ambassadorship pulled and didn't announce it, is what I heard. But yeah, but I mean, that's crazy.
It's funny. I was at an event and I met a guy who was building it was like a stablecoin bridge between Tron, and I'd never heard of it, but he showed me the volume that it's done, and to you guys' point, it was incredible. Like, it was eye-popping volume in stablecoin bridging there. It's crazy.
If you look at most centralized exchanges now, certainly offshore ones, because anything not in the United States is offshore by definition because we run the world. But if you look, the now default option for sending a stablecoin is TRX. You have to actually toggle generally off of TRX to ETH to choose that chain because ETH fees are relatively high. So I'm assuming the exchanges want to push you towards the cheaper one. But more interestingly, and Josh, we've discussed this before, but what you just described that we agree upon about stablecoins, that was supposed to be the thing that Bitcoin fixed, right? Was solve for hyperinflation, low fees, remittances in El Salvador, all of these things. And now, like, you can't even send Bitcoin for less than $40 a transaction because of ordinals and BRC20. And by the way, apparently now Saylor likes ordinals. I don't know if you saw that.
Is he going to sell all his Bitcoin and buy ordinals with it?
I don't know, man. But like, so are we back to like really like our only major use case is cheap and fast stable coins, and therefore the United States government should just give us some stable coin regulation and we move on?
Scott, something I'd like you to speak about is I know you guys had that booth with Shrapnel at Consensus, and I think gaming is a really, one
that
of the
booth was sweet. That was the one across from the tie. That was I played that game. That was awesome.
We just did that, Josh, just to fuck up your booth.
I know you totally did. My booth was like so hidden in the corner, and then you guys were all over the place. But
the CoinDesk folks told us we're across the street from the tie, so we said, "All right, we're building."
Have you guys ever seen the famous meme where it's like people are at a party and there's a guy in the corner who's like they don't know about like hyperinflation in Venezuela? Josh at the tie booth.
If only they knew about my data on Tron.
But seriously, go ahead, talk about it because it's a legitimate question.
Okay, so we've had years now of like shit games on chain that no one wants to play that were pure speculation, literally dookie games. And then meanwhile, there's been like 4, 5, 6 major games that have been incubated with a lot of VC money that are actually decent, surprisingly good, surprisingly fun games, like more than just like a Call of Duty knockoff, like actually a decent game to play. Got a lot of data. They got a lot of users that are about to onboard. Do I think these games are going to eclipse like Activision Blizzard or eclipse Riot or eclipse Epic? I don't know.
But they don't need to.
They don't need to. And I think they're going to get a massive market of gamers like the 24-year-olds that were trading Pepe and just made $2 million are now going to buy $100,000 worth of weapons on Shrapnel on chain on some Avalanche subnet, I guess. So like you take that and then you see this world where like think about like Web 2 games like Roblox that have their own in-game market. And they're doing like billions on some Stripe payments backbone or something. What if that backbone of a video game was one of these US banks or MasterCards or Wells Fargo's future chains? I don't know. Maybe that's good for the US.
You guys see the new,
what if it's
go ahead.
Stripe's come into the space doing their own on-ramp. So chances are it'll probably still be Stripe crypto.
So what we did at Consensus, Space and Time built this crazy ass booth with Shrapnel, demoed the game, showed everyone how epic it is. Space and Time's managing all their data and just showing all these crazy visualizations of what's happening on chain versus in game. Players like buying NFTs and that converting to a weapon. And we're just trying to show like, hey, there's data that's coming from these games about like NFT transfers of like 24-year-old Pepe traders buying Shrapnel weapons afterwards and like. There's activity. It's happening. Crypto's not dead. Web3 gaming's not dead. It's actually about to launch. We're about to see over the next year, like 4 or 5 major AAA games that raise like $100 million of VC finally launching and garnering like this massive cult following of 24-year-olds that love to shoot shit.
Are either of them called Illuvium or Star Atlas? Because I own a whole lot of those tokens.
Illuvium, Wildcard,
99.9%.
Dead Drop, all the fun ones.
So you think that we will legitimately see AAA game? I mean, I did mess with Shrapnel. It was really cool. So you think that these are going to be legit games that people maybe even outside of crypto will play, and this will be sort of the bridge? Because I've had my doubts.
Outside of crypto.
No, I'm saying, do you think it can bring in the Call of Duty people and the Fortnite people? They're good enough games for that.
I think so. Yeah.
Cool.
Now
that's awesome.
Do you think the games kind of default to the like lower fidelity ones, like more like 2D style games?
It's just gonna be like AAA on the console or on the computer versus like mobile games, right? That's the future. It's a complete bifurcation. It's either mobile or it's just fully like full first person shooter, Unreal Engine. But Scott, yes, these games rock. Yes, these games are going to onboard like maybe the best ones, a couple million users.
It's a lot.
But the market, the transaction fees that brings to whatever chain they run on are still nothing compared to Justin chilling in Geneva on his Tron bridge.
Yeah, I mean, that's true. If they do it on fast and cheap, it doesn't bring that much. But maybe, I mean, I guess the silver lining there is
you can't ask for something
the rest of the ecosystem and start to care, and it drives them to other places. I mean, which anecdotally, like people can say whatever they want, but Doge has probably brought more people to Bitcoin than Bitcoin maxis have brought people to Bitcoin.
Not a lot of Elon tweets. That probably made the biggest difference.
Yeah, which one way or another. But it's funny. I don't know if you guys saw, like, it wasn't that long ago, maybe last month. I'm trying to find the article. Yeah, hundreds of Roblox users may be engaged in money laundering, court filing claims. So Roblox has actually been aggressively used for money laundering. But I don't hear Brad Sherman out on a rant against Roblox.
Yeah, you got like dangerous organizations playing Roblox games to like cash out.
Oh, so that's great. So now
That's
like
nice.
gaming and crypto is going to bring us a whole other, it's going to become the new Silk Road. Awesome. But Sid, I mean, you guys are building quite a few things that are going to bridge this to the real world, right? Anyone who didn't listen, Sid and I did a podcast maybe within the last 3 weeks and went deeply into this. But you obviously have some serious optimism about what's being built here and that we can sort of bridge it to the mainstream, regulation aside, obviously.
Yeah, absolutely. We're seeing, I mean, to the point Josh raised before, like, stable coins are an example of real world asset where it's effectively a tokenized bank deposit or a tokenized T-bill holding. And what we've built and what we're launching in the next week is this cash management product, which is, we lend to an SPV, the SPV buys T-bills, pledges them as collateral for the loan. So it's kind of like a tokenized repo. But when you look at how repos and these kind of instruments are limited in traditional finance, they can only, they only settle at the end of the day. They only trade during US banking hours. So when you put this thing on a blockchain, you free up after hours liquidity and settlement in minutes. So it's like, it's a nascent small space at the moment, that type of product, tokenized T-bills, tokenized repos. But I think over time, that's going to expand significantly. What organization wouldn't want the ability to get, overnight interest rates after hours or on weekends and banking holidays?
Do you think that that could actually see interest from the big banks and these companies? And I mean, Scott, you talked about them building obviously their own blockchain. So something like this would be extremely interesting, and that could actually help us in the sort of fight here against regulators and legislators. I mean, isn't that would be the way to backdoor this, right? Is if the institutions actually really start adopting it, and then they're in bed with the legislators anyways.
I hope it backdoors it. And I think everyone has this optimistic, maybe unnecessary optimistic feeling that like a new regime in the US in a year and a half flips things around, life goes back to normal. Meanwhile, these major financial institutions also release their public chains and maybe business is booming.
Well, I think, nothing's going to drive action like the profit motive, right? And so, we talked about the Tether report before, but if I'm a financial institution, nothing is going to be more enticing than seeing that some other company made $1 billion in a quarter of profit just from holding cash and issuing a token against that they didn't have to pay interest on. I mean, that's the banking business model. Like, we actually saw a lot of banks suffer because they were paying too much out on deposits, and like Silicon Valley Bank, then got pushed into longer dated bonds to try and earn interest because they had to pay out this amount, like this whopping interest rate to keep depositors there. But if you're running a stablecoin business, it's the inverse of that. You pay nothing to your depositors.
Right.
It's like it's a negative working capital business.
Right. So this actually makes a lot of sense, right? It's to anyone who's been here, you can scream from the top of the mountaintop about all of these incredible use cases and reasons that we should be tokenizing or financializing these people's assets, but it just seems like the regulators and legislators, at least this particular regime, they just don't want to hear it, which to me just means they're taking money from the banks. Let's be honest, right? I mean,
yeah, but it's interesting. Like being at a couple of conferences these past 2 weeks, what I heard was how keen, banks are now. They feel like they've got the green light in regions like Hong Kong, for example, to come and start offering these types of services. So it's just you just see regulatory competition between jurisdictions where if a bank can offer, if a bank in Hong Kong can offer services to crypto companies and start issuing its own stablecoin, quickly it's going to induce other banks in other jurisdictions to lobby for those privileges.
Yeah, that makes sense. Stable coins. It always comes back to stable coins. I do think that we're going to get stablecoin regulation or legislation. Josh, am I crazy? I think that's low hanging fruit, and that's what we might get at some point.
We did see Hester Pierce last week in London make a comment that she liked the MiCA regulation that the EU had passed, and was interested in looking at similar regulation in the US. So I think it's definitely a conversation. It's definitely a subject of conversation. And I think if Gensler gets his way, he'll just unilaterally pass it.
Yeah, I'm sure. But it doesn't seem like anyone's stopping Gensler right now. I mean,
no, did you see the Democrat meeting notes for the hearing today?
They literally prepped every Democrat with a document that said, here's what you're allowed to say about crypto, and make sure that you confirm that Gary Gensler has power to regulate all of it. That's literally like released meeting notes for anybody who didn't see this. Before a meeting, they were like, I don't care what you think, this is what you're going to say. But interestingly, I want to say, I talked to Pascal from Ledger, the CEO of Ledger, yesterday for a podcast. It's going to come out. It's going to come out next week, and he said that he's in Washington right now. I was like, "Are you in Paris right now?" He's like, "No, I'm in Washington." And I was like, "How's that going?" He was like, "It's actually amazing." He said behind closed doors that a lot of these legislators are actually willing to listen. They're kind of well educated on it, and then it just seems like you can only say what you can say publicly, but that they're actually listening privately. So as another silver lining, he gave me actually quite a bit of hope that there's people in government who get this and who want to see it move forward. Now, the caveat is he might have just been meeting with like Warren Davidson and like the three other guys who we already know love it. But he had a lot of
encouraging.
Huh?
That's at least encouraging.
I found it very surprising. Josh, you'll like this. Something else just completely pivoting. He said that they've now started indexing. You know, we've obviously, speaking of correlations, and you're a data guy, we've seen a decreasing correlation of Bitcoin to the NASDAQ, obviously, and an increased correlation with gold. He said when you bundle the price of Bitcoin with the sales of custody wallets, of their wallets, like during SVB, FTX, things like that, that it's almost like 100% correlated to gold when you combine sales of self-custody devices and the price of Bitcoin, which I found incredibly insightful and interesting. And now you guys don't need to watch the podcast. You guys should just ignore it when it comes out next week.
Thank you.
But I found that extremely compelling, because we do have this sort of prevailing narrative still, I think, that Bitcoin is just a risk-off asset and that it's going to do whatever the NASDAQ does. But I don't know if that's the case.
Correlation with gold is actually decreasing again.
Like this week? Give me some time frame.
What offsets it? Does the correlation with the NASDAQ increase when that happens?
I see you've got your screen here. Ready?
There we go.
So, I mean, 30, 60, 90, 1 year, 3 year. I mean, correlation is very low with
that's gold. Not what I had read, man. That sucks.
How would there even be enough data on self-custody wallets to ever use?
Oh, that's NASDAQ. What about gold?
NASDAQ. That's NASDAQ.
Yeah, that's not even correlated. That's what I like. Give me that.
Well, the S&P and NASDAQ over the last year have been significantly more correlated than gold.
I mean,
0.5 on the
numbers
NASDAQ,
actually
gold is 0.167.
That's really low too, though.
It's way lower. Gold's correlation over every time interval is lower at this point than the NASDAQ's at least.
Do you think that, I mean, going by what Pascal said, and I can't obviously like vet that data, but I mean, do you think that we are seeing a real move towards self-custody is that, I mean, I'm assuming that's just crypto natives.
I think if the IRS gets in front of the line as a creditor, every single crypto native person is going to be, I am not putting my money anywhere unless it's on my own hardware wallet.
Go ahead, Scott.
I see the opposite happening. Josh, like what you said logically makes sense. That's what you think would happen. Like that's what should happen, right? Like I should be going and buying a hardware wallet and moving everything. But like, I think the opposite's occurring. As better user experiences, more options for custodial, more like Fidelity allowing me to invest my 401k in Bitcoin now and like hold Bitcoin in my Fidelity account. I just think the retail just goes whatever path is simplest.
I didn't say retail.
Like I think retail just does is the laziest shit ever. And buying a hardware wallet and configuring it is like
I wasn't referring to
what a retail person's willing to do. I see a correlation the opposite direction.
No, I wasn't referring to retail. I was saying if you had like if you are a creditor to FTX and you are owed money because you had capital on FTX, and all of a sudden the IRS comes in and takes that money in front of you, you're going to be like, are you fucking kidding me? I'm not keeping my money on an exchange again. Right?
What does that have to do with the correlation between gold and self-custody?
Nothing. This is a different conversation. We've moved on.
We've moved on, Scott. Keep up.
How did
I agree with you.
I just don't see a correlation. I'm coming back.
No, I mean, I think, Scott, like anecdotally, what you're saying is absolutely true, especially new. I think you have to sort of bifurcate the extreme crypto native believers and anyone else who's coming in for all of these other use cases. If you're coming in through Pepe, or you're coming in through gaming, you're coming in through NFT, you're going for UX UI, right? It takes a long time for people to get the self-custody memo. But I do think that as self-custody does become easier and we abstract away the keys and all of those things, and as you increasingly are able to interact from your own custodial wallet, like if you can do everything that you can do on a centralized exchange in DeFi with like a robust order book and just sign it on your device, that could, I think, get us much more further in that direction. Right now, it's just not there.
You got it. So the answer is this: it's not going to be hardware wallets. It's going to be Venmo-like apps that let you self-custody, that let you log in with like your fucking Facebook login. Yep. And self-custody on a Venmo-like app, but it will certainly not be hardware wallets. You just said it correctly, Scott.
I disagree. I think you're going to end up at like a quasi, like a hybrid of it. I mean, already we're using at Maple. We just started using Credo for this new pool we launched.
They're awesome.
And we use an MPC, but there's a key held, securely on my phone. So it's like a hybrid. It's, I'm not logging in anywhere with my email. That's too unsecure. But I think you'll see this like 2FA on people's phones, and with like the Solana, the Saga mobile as well. I think you'll increasingly see hardware devices blended into like things that we carry every day, whether it's your Apple Watch or your iPhone or something like that. Doesn't necessarily mean you're going to have to whip out and do the pin on a Ledger.
That's the bet that Ledger's making with stacks. I mean, Ledger, I don't know who's seen stacks, but it comes out in June, but they're literally stackable. So you can have your wallet that you carry around to show off your NFTs or $1,000 here, but then your real self-custody, and they stack up and have this sort of incredible rounded screen. So, I mean, they're trying to make the iPod for self-custody, right? So maybe there does become a device, but I think, Scott, to your point, or Sid, to your point, more likely it becomes something that's integrated into the iPhone, right? Yeah. But Sid, I want actually, honestly, the 3 booths that I spent the most time at in Consensus were playing that game, Shrapnel. So your booth, I didn't even know that. I mean, I was just hanging out with Josh the entire time. So I basically like was paying rent at the tie. And then Credo's booth, because like I did a full walkthrough with their team and met them and then just started hanging out and it was cool. So Sid, can you talk a bit more about that technology and how that actually is changing things? Because I thought that was incredibly cool, novel solution for self-custody.
Yeah, Credo is great. It's a it's a self-custody MPC solution that is, enterprise grade. So we use it to secure a new pool that we set up. So for cash management pool, it's going to be secured by Credo MPC. You can manage it on your mobile. So if you want to approve a transfer or whitelist an address, you can configure it to do a 2 of 3, 4 of 7 type approval. And every time one of those transactions goes through, the people who need to sign and approve it will get a notification on their mobile to do so. So for us, we, different from a Gnosis, for example, where when I'm using a Gnosis multi-sig, I'll connect a hardware device and have to use the pin on the hardware device. This is much easier, just being able to use my phone to approve it. So I think it's great technology that Credo's put together. And we see a lot more clients now using this too. So whether they're lending or depositing into a Maple pool or borrowers who are drawing down loans, I think this self-custody and MPC technology is the future for institutional adoption of crypto.
Right. So do we think that your everyday user who comes in, assuming these products get enough visibility, that process you just described or the evolution of it becomes simple enough that like, I just do that when I want to interact with DeFi, buy meme coins, buy NFTs, all this stuff? Because I mean, that could be the answer right there.
It's pretty, yeah, because the user experience is converging to what you do when you want to log into, GitHub or your Google account. You have like an authenticator app where you input a
Yep.
PIN to open it up, and then you punch in a bunch of numbers that qualify as 2FA authentication. So, you're always carrying around your phone with you. So it's just converged the user experience of using crypto with the user experience of using any other number of apps, including, Google, which now powers most of our lives these days. So I think it's a big step up in UX. And I think as well, the convention, everybody says, well, my grandma's not going to do this, but what happens instead is that you get used to it, and then you get older, and that becomes the new standard. And then the kids who are younger than you grow up with an even different standard. Think of all the things you do with your mobile that your grandma wasn't used to doing, right? Like inputting your PIN every time you want to open it up and call someone. These all just become standard, like people's practices and habits adapt.
Sid's basically saying he's becoming a grandma. That's what I'm hearing.
My grandma bought Coke for a nickel.
So
rest in peace, grandma.
Drink?
But yeah, she. Well, not the drink. Come on. Oh shit.
I mean,
stop.
Yeah. I mean, like, the thing is, right, is like there's this web like 2.5, and maybe this is maybe if you want to find correlations, maybe the correlation is like, okay, the US is building its own blockchains, plural, its own Web3. And maybe that Web3 for retail and institutions, like you said, Sid, is two-factor auth on chain, where there's so much abstraction away from like a single private key or an MPC, like layers and layers of abstraction, stacks of like, okay, there's the chain, then there's like an L2, and then there's an L3, and then there's an app, and then there's an MPC wallet, and then there's a bank, and then there's your like 2FA with like your Google email and like your OAuth app. And at that point, like, the blockchain is 8 layers down anyways. And so it's just a new Web3. It's not what we're used to. You're not touching ETH and buying Pepe with your MetaMask wallet. It's just something totally, it's basically Venmo.
Yeah. I was on Spaces with Sandeep the other day, and I've been on there twice from Polygon. And it was like the ZK syncs and the optimistic sync roll up NFT, SEO, PPIs. And I was like, dude, if we're saying any of this stuff a year from now, literally just kill me, A, but B, we've completely failed. But to your point, like,
EVM
it has
equivalent.
to be abstracted away. It has to be.
But the ZK EVM is like EVM equivalent. We're like, cool, man.
Yeah, but like, who wants to hear that? Like, do you think that that's helping our cause? Can't you just say, like, we're going to make this stuff faster and cheaper and call it a day?
Well, but they're targeting a different audience, right? Yeah. They're targeting like the Scott Dykstras who are like, ooh, tell me about that Z. They're not targeting the Shrapnel player who's like buying weapons NFTs on Shrapnel. They're like, bro, I don't give a fuck. Just like, give me my 2FA wallet. I'm going to own my own weapons. Apparently I'm going to play that game. Sorry, go ahead, Josh.
No, I was going to say, look, I mean, I agree with everyone. Like, you're not going to have mainstream crypto adoption with the current user experience of crypto and how you actually interact with it, right? I think there are financial products that can operate with the current, UX. Like, I actually think the user experience of Uniswap and other DEXs is pretty great. Like, it's very easy to get capital on and start interacting with the DeFi application. I actually think DeFi, at least DEX, is getting better. But I think for some of these broader interaction types, like remittances or sending money back and forth in a Venmo style or interacting with the game, I think a lot of that is also going to come down to like what Reddit did, right? Reddit built their own wallet for Reddit, right? And I think you will have some level of native wallets to predict your applications. I think the challenge that we have as an industry, or not as an industry, honestly, it's not on us, but I think that a layer one has is figuring out like, okay, I am Ethereum, I am Polygon, I'm Avalanche, I'm any of these other, blockchains. How do I get a user in the door and then retain them and get them to use other things on my chain, right? Because if it's so abstracted away like that, to your point earlier, I think, Scott, is how does the value actually accrue to the token, right? And I'm sure publicly what they'd say if Gensler was asking is that we don't care about the token price. And, we just care about the utility of the blockchain. But I think, if you're in this layer one race, or I don't know if it's a race or whatever you want to call it, right? You want people not just using you, like, you don't just want Shrapnel on Avalanche. You want every transaction to occur on Avalanche, and you want people to be able to bridge money two different games and different activities within the chain, right? And so it's kind of these competing priorities where on one hand, I think the layer ones want all that activity to occur on themselves, but I think the consumer just wants an easy experience, right?
The problem is that we see is like outside of ETH, outside of Bitcoin, all the other, call them all L1s. I don't know if I agree with that term, but other L1s, they actually lose the most, Josh, in that situation where you get these gamers in who buy assets on an Avalanche subnet or on one chain and bridge to the other. And, you know, the bridges win. Whoever's taking real transaction fees wins. The L1s lose.
Well, I think it depends on the way.
0.00001 like cent of gas. When it all adds up after the year, they made like $9 million the whole year or something. Like for like a, you know, a chain with a market cap of, let's say, like 10 billion hypothetically, will make like $9 million in transaction fees or gas fees after all of this. The bridges win. Like Jump wins, the layer zeros, like whoever's bridging the assets, because they just take crazy transaction fees. The L1s, they just
some of the L1s keep in mind
in a retail bag.
Some of the L1s own their own bridges too, so keep that in mind. But that doesn't necessarily go to the token holders. That goes to the legal entity that owns it. But I do think like there are some tokens that are trying to solve for that, like Avalanche. To your point earlier, like with subnets, right? Each subnet needs, you know, validators, right? And the validators need to purchase a Vox token to actually validate on the subnet. And if you have a large number of things, you know, a large number of subnets that have launched, the theory or the idea is that that's going to take a large number of tokens out of circulation, right? So I think some guys are trying to think about these issues, right? But the challenge is, yes, is the token actually worth anything for any of this stuff? Is obviously.
Yeah. I think the bridges are an interesting one because value accrue. You know, it's like you have a highway. Somebody can't replicate the highway and dump it in the exact same spot. Whereas with bridges between blockchains, you can actually have an infinite number, or maybe not an infinite number, but you can have multiple bridges, right? So does it just become a commoditized product where they get competed down on price? Like it's hard to see a lot of these business models not just getting replicated to the point where they're forced to compete in a race to the bottom on price. That's why I tend to think that the value will accrue at the application layer rather than this, rather than fat protocol thesis.
I agree.
At the application layer, I mean, another conversation I think I was having with Anatoly from Solana, which I think comes out this Sunday, but we were talking about whether these things even needed tokens, Josh, right? You want the value to accrue to the token, but do you even need one? And he was like, well, like he listed off like 5 companies, OpenSea and such. He's like, none of these have tokens and they're the winners in crypto right now. Like the picks and shovels that don't even have them, like that actually, like Scott, you said, like they're making money, like actual.
Well, you're describing space and time now. Like space and time is a pick and shovel. It's a massive database for all the blockchain data that other protocols run on. Like we intend to drop a space and time token, but we need regulatory clarity. In the meantime, we have advisors or folks in the industry saying like, do you need a token? You take transaction. I said what the equivalent of like subscription model transaction fees. You have revenue, Scott. Do you really need a token? I want to drop a token because I want to build a community because it's fun. Like that's why we're in Web3. Like there needs to be a space and time token. The question is how, when do I need to move to Aruba to make that happen? Do I need to go like become the mayor of Geneva just to drop a token? Right now, I see no regulatory clarity. I live in Southern Cal. I live in LA. Like I'm not going to go sit in front of the IRS, sit in front of the SEC in front of Gensler and try to like beg him to let me drop a token. We're picks and shovels. We have great revenue. Our business is growing. Advisors are saying, Scott, do you need to drop a token? I want to.
Yeah, but right. So, I mean, I totally agree with that and get that. Want and need are two very different things. But I guess the point here is that the tokens are for fun or they're for, let's be honest, instant liquidity, right? It's just a hell of a lot easier for these projects to get a VC if they say you'll have 10% of your investment back 3 weeks from now, right?
I also think there's a world in which these tokens can accrue value to the token holders. Like Uniswap has a large number of fees. Right now, Uniswap tokens aren't accruing. Wow, look at that comment. Sid, your mom.
I didn't do that. Misha, the producer, liked that so much that we wanted to know. Sid, come back anytime. You're welcome. Yeah.
No, my point is like Uniswap accrues a ton of fees, right? I mean, I could pull the data up if we want, but hundreds of millions of dollars, if not higher in fees, right? All those fees are currently going to LPs, right? Theoretically, Uniswap could turn on that tap and accrue fees to token holders. But the problem is that can't happen within the confines of current regulation, right? Because immediately that becomes a security. So there's actually a world in which, like in the case of Uniswap, the Uniswap token could be worth something, right? It could be worth a significant amount of money. There's a significant transactional volume that occurs on Uniswap, right? But today it's not, just because, they can't turn that tap on because, immediately the SEC would go after them.
While we're doing comments, Cloud Casino says, why not add Bitcoin or Satoshis to your game instead of making your own shitcoin? Why, Scott?
Oh, to me?
Not to you specifically. But there's clear answers to this, by the way. But this is Clout's our resident Bitcoin maxi in the chat.
I think it's a fair question. I mean, to be fair, we are. I mean, like there are new projects coming out that do like shit like restaking or something where like space and time doesn't in the short term, until there is regulatory clarity, until we are ready to drop a token and put it in a maple pool and whatever else, like there are ways that we can leverage Bitcoin and ETH and have some public chain value accrual that retail can participate. We can build a community while we figure out our token plans. Like that's fair.
Yeah, but I mean, yeah, tokens I think are useful. We're just in this trough of the bear market. So everybody's saying that they're not, but then as soon as the market picks up again, everybody's saying, why don't you have a token? But if you look at what it can do, can subsidize customer acquisition cost, can be used for M&A activity. Polygon bought a company using their token. We did similar actually when we moved on to Solana. And then cap table management for employees. Like if you're an employee at DCG or one of these other large companies, if you have an exit, then you have to sell your equity at like a 50% discount. Tokens, you don't have to do that. So it's just more efficient. And that's purely just because of an inefficiency with illiquidity in private cap tables. So tokens unlock that. So they do solve problems. It's just, to Josh's point, there's a ton of regulatory opaqueness around how they should be treated and what are the consequences of having one.
Yeah, I think maybe the inherent challenge there is that in the few cases where people use them properly, you're 100% right, but then 99% of people just take it as an excuse to print some money and make a meme overnight and move on. Guys, I can't believe it's 10:30. That's an hour. That was the most fun, entertaining panel. I feel like we should just like do this all the time. And Josh, and maybe invite John from.
Yeah, we need to bring John on. I'm bringing John on to my podcast next week. Sid has been a fantastic guest in the past. To talk shit about the markets. That will be a very entertaining. There's going to be nothing positive discussed for an hour. It's going to be great.
We were for Sid and Scott. It was me, Josh, and John from Blockworks. He's editor in chief of Blockworks, right? Yep. And we were sitting having some drinks at Consensus, and we came up with a podcast or show idea called "Talking Shit" and then coins in parentheses, and that was going to be the name of our show. But I feel like you guys could talk shit coins with us, and it can be bigger than three men.
I love it.
Absolutely.
So guys, listen, everybody, please follow all three of these guys. They're awesome. Scott, it was nice to meet you. I'm glad this is the first time. You're literally welcome back anytime. We accept people who just want to print coins for fun here.
Hey,
we don't judge.
Scott, it's been an absolute pleasure.
Awesome. Josh, Sid, as always. Everybody else, I'll be back tomorrow. It's Friday, so we rant about news on Friday. Should be a good time. I know Josh had to go. Later, guys. Everybody, see you tomorrow. Peace, guys. Thank you.